Thank you everyone for joining us. Today we have the CBR Symposium on mitigation methods for maximal extractable value. So we have this symposium because MEV has a profound impact on blockchains, and questions that are often asked are along the lines of what's being done to mitigate MEV and what does the Ethereum protocol do to mitigate MEV. I recently wrote an introduction post to MEV mitigation. However, MEV mitigation today is a huge space which develops very, very quickly. And that's why today we have three different experts from three different perspectives on MEV mitigation. We have Shea Ketsdever, who is a product team at Flashbots, who can give us an infrastructure perspective on MEV beyond mitigation. Then we have Ciamac Moallemi, who is a professor at Columbia University, who can give us a view from the application layer in his talk titled DeFi in the MEV era, application level and mitigation strategies for MEV. And then finally, we have Barnabé and Monnot, who can give us a perspective from the Ethereum protocol in his title called Protocol Rules and MEV Opportunities. So without further ado, I'd like to ask Ciamac Moallemi to begin his presentation. So let's give him a warm welcome.
Thank you, Julian. Let me just get my slides shared. Okay, I think that's working. Yeah, so it's a pleasure to be with everyone today. My name is Ciamac Moallemi. I'm a professor at Columbia University. In addition to that, I also interact quite a bit with industry. I'm a research advisor for Paradigm, which is one of the largest venture capital firms in the blockchain space, and also a research advisor for Uniswap Labs, which operates some of the largest automated market makers in the space. So what I'm going to talk about today is MEV, really from the perspective of DeFi. Just in the interest of interactivity, I would highly encourage you to ask questions as the talk goes along. I may ask Julian to let me know if some questions appear, because I won't be checking the Q&A myself, but would love to answer things live to the extent possible. Okay. So what I'm going to talk about today is MEV as it relates to trading in decentralized finance. And the reason to focus on this is really it's the dominant and also prototypical form of MEV. It can destabilize consensus, and it has indeed already altered the market structure of Ethereum. So, for example, the shift from priority gas auctions to a PVS, the concentration of the builder market, and so on, is all downstream of MEV that comes from DeFi trading. In my view, this type of MEV extracts profits from end users, be they traders or swappers or liquidity providers, and redirects those profits to intermediaries in the MEV supply chain. That could be proposers, could be arbitrageurs, searchers, could be block builders, relays, wallets, etc. However, wherever it goes, ultimately it is overall reducing welfare, right? And I think the way, the classical economic way to sort of think about welfare gains from trading is that you have a welfare gain from a trade when someone with low idiosyncratic value for an asset sells to someone with high idiosyncratic value, right? So maybe the Ethereum token is too risky for me, for my portfolio. I don't want to own it. On the other hand, Julian may, have sort of very high aspirations for the future price, right? He may indeed want to own it. So when I sell to Julian, both of us are better off. And welfare is ultimately maximized to the extent that we can maximize this type of organic trade. Well, what happens with these intermediaries is they create frictions, right? They're sort of there because they can make money. They're generating a profit. The profit is coming from one of these sides of trading, and ultimately that will reduce the level of trading and ultimately reduce social welfare. My view is that all MEV is bad MEV, and ultimately should be reduced and ultimately redirected to the application. So rather than just being sort of abstract, let me dive in a little bit into sort of what I mean by this. So maybe the dominant form of such DeFi MEV is comes from AMMs and what's sometimes called sniping MEV. And the idea here is that prices on an AMM live on a blockchain. And as the real world is evolving, and maybe on the blockchain, you're in between blocks, the state of the blockchain is not evolving, those prices become stale. And then you may have agents, call them searchers, arbitrageurs, who show up with better knowledge of the price because they can see where the price, the asset is trading in other venues, for example, in centralized exchanges. And when they exploit those price differences to make money, their arbitrage profit comes at the expense of liquidity providers. Now, this isn't a phenomena that's unique to decentralized finance. It occurs in traditional markets as well, under the rubric of high-frequency trading sniping, HFT sniping. And basically, the idea is inconsistent prices between the AMM and somewhere else, be it a centralized exchange, be it other AMMs, but ultimately inconsistent prices between the AMM and some credible public signal of value. So when I say arbitrage here, it sounds like there's a true arbitrage and that maybe you're buying on the AMM and selling on Binance. That doesn't necessarily have to be the case, right? And in many cases, the arbitrageurs only execute the mispriced sides of the trade on the side on the AMM. And so hence this sometimes goes under the rubric of statistical arbitrage. Right, but it's really about inconsistency between prices and publicly viewable, credible signals of value. Now, there is a view out there that arbitrageurs are providing a service here. In other words, the service that they're providing is they're correcting prices to what the fair market value is. And I think there's truth to that. They are providing a service. But the point is the service should be very cheap. Right? If this is an obvious thing to do, if anyone can sort of see the price on Binance and compare it to the price on the AMM, the ARBs shouldn't be able to sort of charge a lot for this. And so yes, they are providing a service, but potentially we're paying them and possibly other intermediaries way too much. So I've worked on models to sort of quantify this under the rubric of lever and loss versus rebalancing. And we can sort of generally think of this as a framework to quantify how much an AMM would lose to arbitrageurs with access to such a public signal, for example, an exchange traded price. And we can ask a question of how that depends on parameters such as how volatile the asset is, what are the trading fees on the pool, what is the block time delta T. And we ultimately get some formulas to kind of parse these for you. The most important bit is as the block size shrinks, the amount of money that the arbitrageurs make is proportional in unit time. So per wall clock time is proportional to the square root of the block time, delta T, right? So now if we factor in that the block length itself is delta T, the arbitrageur profits are simply that quantity multiplied by another delta T. So you get a delta T to the 3 halves power. And so what you can see here is that our profits are superlinear in a block length. Right. So the corollary, and this is going to be our first mitigation strategy that we'll talk about in a couple of slides, is that faster blocks are one way to mitigate losses to LPs. Right. The smaller delta T is, the smaller the arbitrage profits are, both per block and also, more importantly, per unit time. And the intuition here is actually quite clear. The intuition is that faster blocks create more intense competition between arbitrageurs. So let me just pause and explain what I mean about that. So imagine we had only one arbitrageur, and that arbitrageur was a monopolist. And imagine that arbitrageur sees a small profitable price deviation. So maybe the price on Binance exceeds the price on the AMM, including the fee, by a very small amount. If you think about this for a moment, even though a profitable trade is possible, the arbitrageur should not trade. And the reason they should not trade is because there's some convexity here. The convexity is that if they wait a little bit longer, maybe the discrepancy will get bigger. They will make even more money, right? However, it could be the case the discrepancy gets less, but they'll never make less than zero because ultimately they don't have to do that trade. So because of this convexity, if there's a small price discrepancy and there's only one arbitrageur in the world, that arbitrageur should potentially wait for a larger price discrepancy in order to be able to make money. right? But it doesn't work that way because there's many arbitrageurs in the world, right? So even for a small profitable price discrepancy, if one arbitrager waits, some other arbitrager will pounce on it. Now, when you have a long block time, the blockchain is in effect enforcing that no arbitrager can trade. And so with a large block time, what happens is you get larger price discrepancies, and the block time acts as a friction, mitigating this competition between arbitrageurs, and you ultimately get larger arbitrager profits, aka more MEV, right? So when thinking about MEV mitigations, that's actually viewed from the application level, maybe the first order thing, and possibly the lowest hanging fruit. Although we'll speak about some downsides in a second, and that's to do faster blocks. Right. The second you do faster blocks, you reduce large losses to arbitrageurs by making ARBs more frequent, and as I explained, increasing the competition between ARBs. Similarly, if you lower gas costs, you have a similar effect. Gas costs also act as a friction, which prevents arbitrageurs from trading, and then later on they trade against larger price deviations. So, again, faster blocks, lower gas costs. That's sort of one direction. I'm going to go through all of these sequentially. Another direction is what I'm going to call dynamic AMMs, which relate to improving the AMM's trading strategy beyond, let's say, just having a constant product market maker or something like that. And then finally, the last two things I'll talk about is different auction-based solutions, right? One class of things called ex-post auctions, one class of things called ex-ante auctions. The difference between these two being when the auction is it held during the process of block construction, or is it held ahead of time before the contents of a block and prices on the market and so on are known? Right. So my plan for the balance of my time today is to go through the rest of to go through these four types of methods to sort of think about mitigating MEV for DeFi applications, in particular for AMMs. Okay, so faster blocks. Again, we can reduce losses to ARBs by making the ARBs more frequent. This can be done by, for example, shorter block times, for example, pre-confirmations, for example, first come, first serve a transaction ordering, which is basically, for the most part, what is done in the TradFi world. Everything is, all TradFi exchanges more or less are first come, first serve. Aside from the fact that it reduces MEV, an independent benefit of this is it's also a better user experience, right? People like to click the swap button and immediately get that result. So it's kind of independently desirable. Why don't we all do this? Well, there's some challenges. Right, it's challenging to decentralize and have very fast blocks. There's issues related to geographic centralization and so on. But maybe more directly, it's not incentive compatible. Right, proposers don't like it. As we saw before, the amount of MEV in a block is super linear in the block time. So the proposers make money by extending this as much as possible. So there are challenges related to decentralization, but maybe another point is that it doesn't fully solve the problem. The result I showed you where MEV scales with the down to zero with the block length, it really relies on prices being diffusions, being things like geometric Brownian motion, like in the Black-Scholes model. Now, while that's fine for a model, that's not quite true in the real world. In the real world, we also have jumps. We have prices that change instantaneously. For example, when a news article is released, or some piece of information is digested in the market. So those types of discontinuities also exist in markets which are first come, first serve, which are effectively a continuous time and may not have a notion of block length. So while faster blocks, I think, are sort of a very obvious direction, it doesn't sort of fully solve the problem. So we're also interested in other solutions. Okay, next thing I'll talk about is the idea of dynamic AMMs. And so here, I'm kind of including anything which changes the AMM's trading strategy, aside from just the baseline AMM of having a curve invariant and a proportional fee. And sort of the key idea here is what you want to do is you want to change how the AMM behaves in order to reduce adverse selection. So we can think that there are two types of traders that are going to trade on an AMM. On the one hand, there are these arbitrageurs. We do not want to trade with them because when we trade with them, they make money and the AMM loses money. On the other hand, there are, let's call them noise traders or idiosyncratic traders or whatever. These are people who are trading for their own reasons, not because the price on the AMM is wrong or not because they have information about value of what the short-term price of the asset will be. What you would like to do is you'd like to trade with the idiosyncratic traders and avoid trading with the arbitrageurs. And the design space of dynamic AMMs is how might you change AMM behavior and or utilize other information in order to avoid this. Like so, just to give sort of a flavor of what some of the ideas might be, you might think about doing things like including price oracles. So a generic AMM will only change prices when someone trades against it, and that might be an arbitrager who's moving the price because it's indirect. But if we had, say, a real-time source of more accurate prices, maybe somehow the AMM could move the price on its own without being traded against. And the arbitrageurs then wouldn't bother to trade, and you wouldn't sort of bother. You wouldn't end up losing money to them, right? So that's one class of ideas, leveraging oracles. For price, volatility is another important input, right? Arbitrageurs typically make more money the more volatile the space is. The asset is. So you could think of, when market conditions or more volatile, you could look at mechanisms which, maybe increase the fee in those circumstances. Another type of mechanism might be looking at the source of the order flow, right? So for example, if you have a trade that's coming in that came through the Uniswap Universal Router smart contract, that's some user on the Uniswap front end. That is probably a retail user. That is not an arbitrageur, right? So maybe you want to offer that person very attractive terms of trade. You want to offer them a lot of liquidity, maybe a low fees, right? On the other hand, maybe if they're coming from their own smart contract, maybe it's much more likely they're very sophisticated. Maybe they are an arbitrageur, and you don't want to trade with them. Maybe you dissuade them with high fees. Right. So there's a number of different projects that I've sort of listed below, which leverage some of these ideas in order to mitigate losses to arbitrageurs. The challenge is that really this is a vast and challenging design space. It's basically equivalent to sort of choosing a profitable market making strategy, and that in and of itself is a problem which I think is not really solved at this stage, either in TradFi or in a decentralized finance. Other problems are that to the extent you want to implement your dynamic AMM in a on-chain fashion, on-chain strategies, because they're implemented through smart contracts, and the typical blockchains are pretty slow, they necessarily have to be very simple. They have limited information, and oftentimes they're also open source. Right, so it's difficult to have a very sophisticated strategy, and such strategies can also potentially be exploited by other agents who know how they work. So one possibility is, for example, to look at off-chain strategies. Right, so we may have an off-chain market maker, a closed source, sort of figuring out how to set prices and fees and so forth. And this is a little bit of the spirit of some of the things we see in perpetuals these days. For example, the hyperliquid vault is can be thought of as a form of off-chain strategy. But of course, there are downsides here too. These are typically closed source. You don't know what they're doing. Maybe they're going to rug you at the end of the day. They could ultimately be centralizing and so forth. So, again, dynamic AMMs, there is a lot of potential here. And these are ideas that a lot of different people are pursuing, but it's not necessarily sort of the full story. Right? So what I'm going to do now is I'm going to sort of shift into auction solutions. And if you remember, I discussed, actually, maybe I'll pause here and I'll see there's a question. The question is, why are LPs paying this high amount? So the question is, why are LPs paying this high amount instead of doing it themselves or removing their liquidity? In other words, isn't the argument you're making that the free market price is incorrect? The LP is free to move their liquidity to L2 with faster blocks, yet they continue paying this price on L1. Okay, so the question is, why don't they move to L2s? I actually do think trading over the long run will move to L2s and or to other chains which are faster. However, you have to bear in mind that it is a bit of a equilibrium problem. You have to coordinate, right? So the LPs want to be where the traders are, and the traders want to be where the LPs are. So it's not that in one instant, everyone's going to agree that we're going to move all our trading from mainnet to base or whatever. So that's a little bit the challenge there. Okay. So in terms of the ex post auctions, here what we mean by ex post, it means after the fact. And after what? What I mean is after the state of the world is known. In other words, after we see what the state of the pool is, what the market price or whatever other variables are known. Once all that state is known, in other words, what we mean is really during the construction of the block. These type of auctions are also often done in conjunction with batch auctions, with the concept of setting a uniform price, right? So again, you can imagine having a batch auction of forms every block. Sort of this world of frequent batch auctions. The nice thing about ex post auctions is in some sense they're easy to participate in because a market price and pool state, everything is known. Right. So if I'm a trader and I want to participate in this auction, I see what the price on Binance is, I see what the price on various Uniswap pools are, so on. I can maybe compute what, and I know my inventory, I can maybe compute what the profitability of the various trades in, and it's pretty clear how to bid in this auction. Also, combined with this idea of trading at uniform price, it could potentially reduce MEV to zero. The idea being if you can do quote unquote auction in a way where everyone in a block trades at the same price, arbitrageurs will force that price to be the fair value, because if it's not the fair value, they can make a profitable trade. But if everybody is trading at the fair value, then nobody is leaking MEV. Right. So the idea is if you can set this up in the right way, and if the mechanism is indeed perfectly competitive, there is the possibility of actually reducing MEV fully to zero. Now there's a bunch of challenges in the design space also. And the primary challenge is because you're conducting auctions as blocks are literally being generated, you can't necessarily conduct that auction with the same consensus mechanism that is generating the blocks. So you need some kind of alternative infrastructure to run this auction. And the two possible solutions are to have a centralized auctioneer who might be a trusted party, or to sort of kind of figure out in parallel to the consensus protocol, running a decentralized auction protocol, right? Both of which, both those options have downsides. Another kind of downside is that composability is difficult because again, I'm clearing many transactions at once. I'm not necessarily doing sort of one transaction at a time in a serial way, where those transactions can individually be atomic with other types of blockchain actions. And finally, again, all of the auction solutions really rely on auctions being competitive. To the extent that they're not competitive, if there's only a handful of people who are able to participate, then there's still going to be a value leaked through the lack of a competition. Right. So there's a number of examples of ex post auctions. So CalSwap runs an auction in conjunction with something called a function maximizing AMM. So this is, again, speaks to the this batch auction with sort of a common clearing price. This is a centralized auction run off-chain. We can even think of MEV Boost, the classic Flashbots product, auctioning off the right to build Ethereum blocks. That's also an ex post auction. This, however, really doesn't fit in our design space because the revenue is going to the block proposer. And again, for reasons that I articulated earlier, we really want the revenue to go to the liquidity providers, the people who are losing money. CalSwap and MEV Boost are both centralized off-chain solutions. You also have the Sorella team, which is building Angstrom, which is a decentralized solution that attempts to do sort of a simultaneous top-of-block auction for the arbitrage opportunity and a uniform price batch auction for the for trading in the rest of the block. So, again, these solutions I've described require either centralized infrastructure or some additional decentralization mechanism. I do want to highlight one additional solution, which I think has gathered, sort of a lot of interest recently. And this is the idea of priority taxes. Right, so priority act taxes due to Robinson and White. It's a mechanism where you try to leverage the one auction that a consensus mechanism might be running anyway, which is the priority ordering auction. You try to leverage that at the application level in order to capture the MEV for applications. So our starting point for this is imagine that we're on a blockchain where the block proposer commits to number one, ordering transactions by their priority fee. Or tip, if you will. And number two, not censoring any transactions and not giving anyone any timing advantages or anything, right? So this is not the case with Ethereum mainnet, and I'll circle back to that in a second. But it is the case by default, for example, on OP stack chains like Base and Unichain and so on, right? Now, if you're on a blockchain with a priority ordering mechanism, the idea of a priority tax is simply to leverage that auction at the application level. So what, let's say an application like an automated market maker could do is it could say, look, when you're trading against this automated market maker, it can observe the priority fee that you're paying. That's an opcode in the Ethereum EVM. And what it will do is it will demand an additional fee, which is, say, some multiple of the priority fee that you're paying. So, for example, for every $1 paid in priority fees, the AMM could demand $99 be paid directly to the AMM, right? So now, how would this impact the behavior of participants? Well, if you're in a blockchain and the block is not full, it shouldn't impact normal users because they'll put in a priority fee of 0 or something very small, and they won't pay the AMM. However, it will impact arbitrageurs because amongst the arbitrageurs, there's a race to be at the top of the block, right? The arbitrager who's at the very top of the block is going to accrue all the arbitrage profits, and no one else will get anything. And the way they're going to compete in that race in a priority order chain is they're going to bid up the priority fee. And in a competitive market, how much will they willing to bid? Well, the total that they should be willing to pay should be equal to the amount of the arbitrage opportunity. However, the important thing is they don't care where it's paid. They don't care whether it goes to the searcher or the proposer. So when the application introduces the MEV tax, what the arbitrager will, or the priority tax, what the arbitrager will do is simply factor in how much they're going to have to pay the application, and they will be willing to pay up to their arbitrage profits, and ultimately some large fraction, let's say, with these numbers, 99% of the MEV will accrue to the application, which in turn can distribute it to the liquidity providers. So nice things about this, it can be implemented with a couple of lines of solidity. You don't need any EVM changes, no off-chain infrastructure or whatever. It's fully composable. It's flexible to do a lot of other things besides AMMs. In particular, can do things like RFQs and so on. However, the main downside is it really requires that the block proposer respect the rules of competitive ordering. And so, for example, now it's not possible in a decentralized way on L1s, and sort of figuring out how to do this really in a decentralized way is a challenge. So I'm going to talk about just one last idea. This is the idea of ex ante auction. The idea of an ex ante auction, we're going to have an auction like we did before. However, we're not going to do it at the time of block construction. We're going to do it way before block construction, right? So we can imagine maybe we do an ex ante auction of something for the next hour. And again, well before whatever blocks are being constructed over the course of the next hour. This auction is going to be done in a way where the proceeds of that auction are then going to be redistributed according to the LPs, according to different kinds of rules that I'll talk about. And the nice thing about this is because the auction frequency is slow, because maybe we're only doing one auction an hour, the auction itself can be done on chain, right? So you don't need any additional infrastructure. You don't need a centralized off-chain entity or anything like that. So the starting point, I think, for these ex ante auctions is the MEV capturing auction of Alex Herman. And the idea of a MEV capturing auction is what we're going to do is, let's say for the next hour, we're going to we're going to auction off the right to be the first trade in the block. In other words, in any particular block, no trade can happen on this AMM unless the auction winner has already done a trade. This is effectively an auction for the right to arbitrage, because the first trade in the block is going to be an arbitrage trade. So in a competitive setting, the entity who wins that should be willing to sort of pay up to the expected arbitrage or profits back to the LPs in rent. So this is kind of a very nice idea. Should eliminate the MEV. However, the challenge is there's two principal challenges. One is you have to trade in every block. So this unless this lead searcher, the guy who won the auction, trades in a block, there can be no other trades, and so there's going to be gas spent to unlock every block so that others can trade. And moreover, in fact, thinking about the concepts we discussed before, the lead searcher actually has incentive not to trade in every block, because by not trading in a block, they can censor trading, and indeed by censoring trading over several blocks, they can effectively increase the block size and increase the amount of MEV that they can extract for themselves. So that's a pretty significant issue, and to sort of mitigate some of these, what me and some co-authors have proposed is an idea called the auction managed AMM. And here we're also going to hold an auction. Again, we're going to hold the auction to manage the AMM, let's say, for the next hour. However, in our auction, the thing that you earn by winning this auction is the right to, number one, set the swap fee for a given interval of time, and number two, in order to also receive those swap fees. Right? So if you think about this for a second, if the pool manager, the one who wins this auction, receives the swap fees, then when it trades against the pool, it's effectively paying itself the swap fee, so it can effectively trade against the pool with zero fee. And since it can trade against the pool with zero fee, it can capture most of the MEV itself, because if there's a small price difference, it's profitable for the pool manager not paying any fees, but it's not profitable for any other arbitrager because they have to pay the fee. Right? So the pool manager can capture most of the MEV this way, and in equilibrium, they will pay back this MEV to the LPs in the auction rent. And this offers a number of benefits. Not only does it capture the MEV, but it also solves a separate problem, which we haven't even discussed, which is how you set the swap fee. Right? Setting the swap fee, again, is a little bit of a balance between, you want it to set it high in order for ARBs not to trade. You want it, on the other hand, to set it low so that retail users will trade with you. So in order to do this, you have to, understand price sensitivity really of retail users, and this is extremely challenging and also varies with market conditions. Here, we're just punting on the problem. We're going to outsource it. We're going to have a sophisticated agent, imagine Citadel Securities, they will know how to optimize the swap fee, and they can do it off chain. It's also going to smooth the payments to the liquidity providers, and it's going to solve the problem that we had before in that the pool manager here can't censor, because anyone can trade as long as they're willing to pay the fee. Right? Whereas before in the MEV capturing AMM, they could only trade after if the pool manager had touched the block in that trade. So, in theoretical model, again, under competitive assumptions, we've shown that this has more liquidity than any standard AMM. So again, there are some challenges here also. I think broadly in ex-ante auctions, maybe the highest level challenge is the bidding is more sophisticated. If you think how much to bid at an ex-post auction where you can see the state of the world, it's essentially how much can I profitably trade right now? Whereas if I think in an ex-ante auction, I'm bidding for some arbitrage rights over the next hour, it's really like kind of pricing an option, and that might be more challenging. So you might expect only more sophisticated players could participate in these auctions, and they ultimately might be more centralizing. And I'll say also, this is very close to some debates that are being had in US equity markets right now. If you look at the way payment for order flow works in US equity markets right now you'll have brokers like Robinhood making deals with market makers like, let's say, Citadel. They make these deals ahead of time in advance. It's really like an ex-ante auction setup. On the other hand, what the SEC has proposed is a real-time trade-by-trade auction. That's really kind of like an ex-post auction. And there is an active debate on whether these, which of these two methods is better. So I will just stop there in the interest of time.
Thank you very much for your presentation. Yeah, it was very, very interesting. Thank you. So in the interest of time, maybe we can move on to the next presentation, but if there are any questions, feel free to ask them, and potentially we can still answer them async via the chat box. Yeah, so thank you again. And then now I'd like to welcome Shea Ketsdever from Flashbots, who will present as well.
All right, can you hear me? Beautiful. All right, let me figure this out. No, hold on. 1 second. All right. Are you able to see this, or is this just a black blob for you?
It's still black now. It says Shea started screen sharing.
All right, try something else.
Yep, I can see it now.
Oh, really? Great. Beautiful. All right. Does it change when I... Sorry, folks. 1 second. It's just not quite responding the way it's supposed to. Gonna get out of this. Okay, third time's the charm. Let's see if this one works. Yeah, there we go. Okay. Hi. All right, sorry about that. But hi, everybody. I'm Shea. I'm from Flashbots. And Julian asked me to come and talk today about MEV mitigation, in particular, the sort of applied perspective on products that we at Flashbots and also more broadly are kind of building to mitigate the externalities of MEV. But I'm calling this talk beyond mitigation because I think that we can't just stop at the sort of individual tools and products. We really have to talk about the interactions and dependencies between MEV solutions and how that impacts the sort of transacting experience for users as a whole. But first, like, why do we care? Why do we want to mitigate MEV? Well, really, this is all in service of a larger goal, I think, which is just to give users good execution and good experiences on chain, getting included quickly, safely, at the best price. And the thing is, most people do not care how you accomplish that under the hood about how a specific RPC or OFA or DEX is designed. They kind of care about the overall experience. So MEV mitigation matters insofar as it helps us improve user outcomes, making it fast, cheap, and safe. And I think the thing is, building good MEV solutions and especially getting them to work together well is hard. So MEV is a super complex and adversarial environment, as we know. And so this talk is hopefully going to make you a little bit paranoid. In my experience, basically, the deeper you look under the hood, the more paranoid you become. And I will share some of my own personal experiences to show you why. But also, hopefully, let me see. Oh, there we go. Also, hopefully you will leave more inspired by the generally interesting and hard R&D problems that are yet to be solved, and which I kind of hope some of you will be nerd-sniped into helping us tackle. So here's how I kind of want to spend the time. I'll start with just a very quick primer on the current tools that exist for MEV mitigation to sort of just very quickly set the scene. And then for most of the time, I want to look at the fundamental guarantees we need to make those tools work, to give users great outcomes on chain, and share some real stories with you of how they actually break down in practice. This is the paranoia part. But as we go, I will also highlight what I see as the next sort of trillion-dollar questions, big, meaty questions that I hope you will join us in exploring. And this is more of the optimistic part. I'm hoping that this will give you a sort of bird's eye view of where we are today, where the really interesting questions are beyond just the kind of classic handful of apps and protocols that you, to be honest, are probably already familiar with if you're tuning into this. And if anything really interests you, hopefully this talk piques your interest enough to sort of follow up. So just to set the scene, establish the basics first, what are the tools we've created to give users better execution and experiences on Ethereum today? I'm just going to focus on the very popular use case we were just talking about of swapping tokens on a DEX. How do we give users better prices by mitigating the externalities of MEV today? What are the tools that exist? I think one of the first things that comes to mind for me when I think of DEXs is front running. If you swap in the public mempool, you are exposing your intent to make a trade before it happens. And one of the OG tools to protect people from these risks are private mempools like Flashbots Protect, which give you things obviously like pre-trade privacy and help you avoid sandwich attacks and other things. Another innovation here is new DEX design. So, make the swapping experience itself more resilient against externalities of MEV. And a good example of this is intent-based DEXs, where instead of making some declarative statement about how to execute your trade, the user just kind of states a more general goal they have. And this is nice because it means we can use more sophisticated parties to figure out the best route, so users don't kind of shoot themselves in the foot as they want to do. And a final popular thing that actually we were talking about earlier is MEV auctions, like order flow auctions, which auction off the right for sophisticated parties like searchers to back run your trade and share MEV, maybe in the form of an arbitrage that your DEX trade created. They can share this MEV with you. And this helps you get a kind of better overall experience and execution beyond just the price you got on the DEX. So in sum, I think these are probably some of the things that come to mind for many of you when we talk about MEV mitigation. Things like better DEX design, which we were just talking about, private RPCs, OFAs, and other MEV auctions more broadly. But I think the thing I want to emphasize in this talk is that to get good execution, you often need to combine many of these things together. It's not enough for one of them to work. You need the whole stack to be airtight. And I think that order flow auctions, or OFAs, are a really great example of this. You can't auction off order flow in an OFA if the entire transaction is also available publicly, because searchers will just capture that MEV created by the trade in form of arbitrage outside of the auction. They won't refund the user. So OFAs actually they have a dependency on other tools like private mempools. And actually, they need other parties in the MEV supply chain to implement some of the key features. So the actual order flow auction service in most cases is usually very simple. It just sort of shares information between users and searchers, and it relies on another party, on the block builder, to choose the right background and implement rules like transferring refunds. So TLDR here, really, MEV mitigation is more than the sum of its parts. And so what I want to show you next is just how fragile this whole interdependent stack is in practice. In my opinion, today, we basically have a bunch of point solutions, but not a well-functioning end-to-end flow. And this causes very real negative externalities for users. As someone who has built a lot of these products, who operates many of them in production today, I can kind of tell you firsthand about some of the challenges we see. I have some receipts that I'm going to show you. And in particular, I'm going to structure this by looking at 4 key properties that I think we would ideally like to see in the overall MEV stack or supply chain, things that apps like DEXs and OFAs depend on. For each of these, I'll kind of talk about how it works today, what's challenging or broken about it, and the trillion-dollar questions that this poses for interesting researchers. And since Julian asked me to, I'll try to also tie this into some of the work we're doing at Flashbots. Okay, so the first property that I think we really need for a functioning MEV mitigation system is integrity, which is basically a guarantee that the app is going to do the thing you expect it to. It's going to follow the rules. And I think the need for integrity becomes very clear when you look at one of the key tools we were just talking about, which is order flow auctions. So like I said, OFAs rely on the block builder to implement certain rules to make the OFA work. And how do we actually do this? Like, how do we ensure that these other actors, like block builders, are following the rules? Well, this is literally what the status quo looks like. We write some rules in a document, and we kind of make a handshake agreement with other people that they're going to follow those rules. So for example, in MEV Share, which is the name of the order flow auction we run at Flashbots, every builder publicly commits in a PR to an open source repo that they were going to comply with the rules in this screenshot that I have included. And other OFAs, like MEV Blocker, for example, have their own kind of similar documents, basically. And there's one rule in here, it's kind of small, so you might not see it, but there is a rule here that I want to call out, which is that the builder is supposed to land the back run that pays the user the biggest refund. Seems kind of sensible. They can't go and pick a worse back run that was submitted and then go and capture the remaining arbitrage themselves. But surprise, surprise, people don't always do this. These are just a small selection I've curated of anonymized receipts from real cases where a builder failed to uphold that exact principle. And I'm not trying to dox people here, but I did just want to show you that this actually happens. So in one of these cases, a builder was intentionally choosing the wrong refunds to maximize external arbs, and we had to shut off their access to MEV Share for some time. Another is actually a case where we, Flashbots, screwed up because we had a different interpretation of how to handle one of the sort of gray areas in block building. And it turns out the way that we were interpreting text written in a document did not match the order flow provider's intentions, and we didn't realize this. So the TLDR here, I think, is that writing up some rules and pinky promising is really a suboptimal way to enforce integrity in the MEV supply chain and in block building apps. And I know this because I'm the person who gets these DMs. Like, these are screenshots from my Telegram. So the question is, how do we go from these off-chain social contracts to real verifiable integrity of our block building apps? I think this is sort of a trillion-dollar question as the meme goes in MEV. And it's a question that we have spent many years thinking about at Flashbots. And we think there may be a path forward. There's maybe other paths forward. I'll just share one with you to make this concrete, which is to run block builders in secure environments like TEEs, trusted execution environments, that are special hardware that can attest to exactly what code they're running. And in doing so, make the rules of block building and all the apps that rely on it auditable and tamper-proof. This is exactly what we're building with at Flashbots with our new decentralized block building platform called BuilderNet, which is a network where many parties can coordinate, operate block builders in TEs. And we're super serious about this. For what it's worth, as of a few months ago, we actually only operate block builders in TEs at Flashbots. We don't run any centralized non-TE builders. And we would really love, I think, to have more researchers and practitioners join us in kind of making this the standard and the default across Ethereum. But it's kind of only one of the properties we need. Integrity isn't enough. We also need privacy. Privacy is essential to prevent front running. I think we all know this on this call, but what I want to highlight is that even if your specific protocol is private, even if you do everything right in a specific product, your users could still be subject to front running if free pre-trade information gets leaked any other place in the stack. You know, the Telegram DMs for this one are a little spicy, so I'm not sharing them. But there have been several cases in practice where builders sort of leaked transactions from OFAs and private mempools, and almost always, for what it's worth, by accident. And it goes beyond the builder, too. MEV boost relays can also be a vector for privacy leaks. So one of the fields that relays share is the Bloom filter of all the logs in a block. And in most cases, for most relays, they do share this data publicly because we want to avoid relying on validator authentication because it can be a bribery vector for reasons that are not in the scope of this talk. But basically, this means that a sort of enterprising searcher can do something clever, pull off a trick that lets them glean information from this logs bloom about transactions that were in private mempools. And a searcher, this is what the screenshot is, a searcher actually published a way to use this hack over the summer. Unfortunately, it appears that this hack may actually be being used right now in practice to harm OFA users, which is not great. I think there are like a few important lessons here. One is that we can't approach this as a point solution. We need a much more systemic overhaul because otherwise users will just kind of continue to be subject to the security of the weakest link in the whole MEV supply chain. In practice, this maybe means decoupling the sort of job of creating secure foundational MEV infra from running apps. Building a giga-performant builder or relay or OFA is somewhat of a different skill set from how do we think critically about strong security properties. And it's possible that what would be really helpful here is having like a unified, separate base layer that gives everyone else a sort of more safe sandbox that they can play in. So what's the trillion-dollar question here? I think it's how do you create that foundational layer that the whole MEV supply chain can run on that has really strong privacy guarantees. This is what we hope BuilderNet will be. With TEEs, we can get not only strong, security, strong integrity guarantees, like we were talking about earlier. We can also get strong privacy guarantees because you can't leak information from these secure environments with an asterisk about side channels and exploits. That is also in scope of a different talk. But this also doesn't just apply to block building. We can actually use TEs to improve privacy and security at other layers of the stack too. So I have screenshotted here one of these designs that we're working on at Flashbots to disintermediate the MEV boost relay as well using TEs. Basically, this design, we realized that if you have a TE block builder like BuilderNet, you don't actually need a relay to revalidate the blocks it produces. Like you already know that they were produced by valid code. And this is really cool because it doesn't just disintermediate a centralized actor in the supply chain, which we love, but also in doing so, it kind of skips over a vector for possible privacy leaks. And I think looking forward, we're also pretty excited about running things like RPCs and OFAs in TEs for better security. So again, if it interests you, I think it's one of the more interesting new areas for research going forward. So just to check in, about halfway through, we've covered security and privacy, two key properties that I think we really need to be baked into the MEV supply chain for all of our mitigation tools, our DEXs, our OFAs, whatever, to do a good job. And now I want to talk about two final properties, the first one being participation. Off-chain auctions are key to user execution. The talk before this, I think, did a good job of giving some detail on that. And many of the tools we've talked about, like OFAs or even intent-based DEXs, use markets of searchers and solvers to try and find better outcomes for users. One thing that I think we at Flashbots, more broadly people in crypto, believe is that it's really important to make those markets permissionless. This is one thing that sets DeFi apart from TradFi. And I think we've also seen in practice, that when you lower the barriers to entry, let anyone bid in your auction, you tend to get more coverage, for example, of like really long tail routes, and also more competition, which tends to improve prices. But it is really hard to both make permissionless auctions and also to permissionlessly attribute and share the value that those off-chain markets and auctions create. And I want to kind of talk about both of these challenges. First of all, permissionless auctions are hard. And a big reason that they are hard is spam. We are constantly getting spammed in MEV Share, the auction we run at Flashbots. Part of this is actually by design. We let users share partial information about their trades to kind of preserve privacy. So searchers have to go and guess many versions of a route. Another reason we get spammed is from blind backrunning bots like this one on the screen, which basically try to pull off some tricks to evade the OFA so they can land backruns at the bottom of the block that don't pay refunds, which, to be fair, we did sort of bring on ourselves by publishing a guide on how to exploit our own top-of-block simulation, RIP. The blind searching problem, for what it's worth, also gets a lot worse on L2s, where block space is even cheaper. People even just run these things on-chain. Okay, so the like result of all this is that because this stuff is hard, unfortunately, a lot of products on the market today aren't permissionless. I just grabbed a few examples from the docs of some popular backrunning products that explicitly require searchers to register and get permission to participate. And I think this is really one of the next trillion-dollar questions. Okay, how do you design permissionless auctions that maximize participation while also being resilient against spam and preserving privacy? Like, how do you make these trade-offs? Do we have to be sacrificing one for the other? And I will actually return to that question in a little bit too. But I also want to emphasize that OFAs are not the only auction that matters for user execution. We've been talking a lot about them, but maybe the most important one is just the overall block auction. Getting good execution for users also means optimizing the fees that they're paying, because MEV isn't just something created by DEX trades or captured by backruns. The vast majority of transactions on Ethereum have MEV in the form of priority fees that they're paying. And in the last year, recapturing the MEV from priority fees has been, one of the biggest metas, I think, on L1. Wallets and apps and searchers have realized that they're overpaying by huge margins on their prio fees, in part because it's really hard to correctly price transactions if you don't participate directly in the block auction. And this has accelerated a whole bunch of off-chain deals where wallets and apps and searchers made deals with block builders to kind of try to reclaim the fees that they were previously just yeeting to validators. And this created what has come to be called the order flow wars, where basically big order flow providers made exclusive deals with block builders to recapture their priority fees. But again, a big problem here is permissionlessness. These deals are opaque, they're not available to everyone, and a sort of classic example here that's been talked about at a lot of length already is the deal between Banana Gun, a top Telegram bot, and Titan Builder, where Banana Gun sent exclusive order flow to Titan in exchange for sort of preferential treatment and refunds. And this deal is notable because it ended up accelerating huge amounts of centralization in the block building market to the point where only two builders build sort of 90% of blocks today, really driven by exclusive order flow. So the question is, how can you offer these same benefits permissionlessly to everyone? This is yet another one of the problems we are trying to solve with BuilderNet. We're trying to we've created and have live a native refund rule inside the block builder that basically automatically calculates after a block is built how much value each person, each transaction contributed to it, and then refunds them a proportional amount of the overall block profits, which come from their priority fees. And this is permissionlessly applied to everybody who transacts through BuilderNet. And so far, we've distributed several 100,000, I think about 1 million in refunds, which is pretty cool, just in the beta phase. But permissionless refunds, permissionless attribution is also very hard. There are a lot of edge cases and ways that people can try to game a system like this to make it seem basically like they are contributing much more to the value of the block than they actually are. And we've already introduced additional constraints to our native refund rule to handle some of these cases. This is a screenshot from our docs on one example. But it's kind of like a game of whack-a-mole. We know that you can solve a lot of the edge cases by just throwing more compute, running more simulations, but that's also not particularly a sustainable solution. So anyways, there's way more I could say about the edge cases and challenges in designing permissionless gas refunds. And if these things are interesting to you, please, whoever is listening, reach out after this talk, because I think it's an important and also very active area of research for our team. We're looking into some solutions for this right now. But in the interest of time, I'm going to move on to the final property that we care about, which is censorship resistance. At a high level, it seems very obvious that we need strong censorship resistance in the MEV supply chain to give people good experiences, which, as you remember, giving people good experiences, in my opinion, is the ultimate goal of MEV mitigation of all of this stuff. Why is censorship resistant important? Well, I mean, getting censored is just a bad UX. And also, if we think about the importance that competitive markets play in giving people good execution, it's pretty clear that we don't want like one searcher censoring other searchers' bids and making the markets less competitive. But it's not as easy as just forcing your MEV systems to include all the transactions they see. As we kind of touched on in the permissionless auctions and sort of spam dilemma, block building is resource constrained. You only have like so much time and so much compute available in each slot. And meanwhile, the complexity of block building, the amount of competition for MEV is basically unbounded. It's really insane when you look at how much just a small number of arbitrage bots are congesting L2s today with their on-chain searching, the kind of evolution of blind backgrounding. And in practice, this means we have to make trade-offs. You have to take a narrower path through the search space, which can sometimes affect users. This is my favorite, one of my favorite blocks in the last year. It's a block built by Rsync Builder, which included only 11 transactions, which is, for the record, very few. Most blocks include a lot more. And 2 of those transactions were the kind of tail ends of a very high-paying sandwich bundle from Jared from Subway, top sandwich bot. And what's really interesting is that this block is not full. There were other valid fee-paying transactions that could have been included in this slot. But it was just the fact that the Jared bundle paid so much that it was enough to win the entire block auction for Rsync. So the builder did not have an economic incentive to spend extra time or extra compute merging other transactions. It just wasn't rational for them to do that. And you can imagine kind of taking this case to the extreme where a single transaction pays so much that it's not worth it to consider any others. This could happen even for many blocks in a row. One searcher, for some reason, just like paying so much that they land the next 100 blocks. Imagine taking this to a real extreme. And so then you kind of start asking, where is the line between censorship and economic efficiency? Like, how do those things relate to each other? I think it's a very interesting dynamic to think about. Our hypothesis at Flashbots is that if you maximize participation and especially diversity in your block building system, then actually the economically rational outcome, the most valuable block, will also be aligned with a sort of most censorship resistant outcome, because censoring transactions generally reduces the value of your blocks. So if you have a system where lots of people are competing to optimize the value of these blocks, it's very likely that the one that censors the least is going to win because it's more valuable. And for this reason, one of our big focuses right now at Flashbots, at least, is how we can create block building systems that maximize participation. This is one of the other main goals of BuilderNet. One consequence of the fact that we're running all these builders and TEEs is that we don't have to trust the people operating them. We just have to believe that the hardware is providing the guarantees that it states. And that means anyone can safely, in the limit, operate a builder and, as a result, participate in the block building process. But I don't want putting the stack in TEEs is not the answer. I think people think that this is the answer, and it's part of it. But TEEs alone do not give you censorship resistance. While they let lots of people participate in your block building system, and they give you really strong privacy and integrity guarantees around computation, all the network traffic, for example, is controlled by the host system. Like, you need to supplement TEEs with additional tools to get strong censorship resistance for your system as a whole. This sort of question of how you actually make the networking level censorship resistance in a distributed or decentralized block builder is one of the most future-facing areas of research that we're looking into now. It's a very interesting challenge, and we're looking for sharp sort of distributed systems minds to help us reason about this one. So, to close out, what should you take away from all of these things that I've said? I think one is just like MEV mitigation is not something that a single app is going to solve. That's not how it works. Getting great execution for users means thinking critically about how all of those different apps and point solutions depend on each other and impact each other. And in my opinion, upgrading the foundations that all of these different MEV apps and mitigation techniques rely on is one of the most important things that we can focus on right now. And I'm hoping that in this sort of grab bag of all of the interesting challenges, that some of you will help come join us and take up this quest to chase down some of these trillion-dollar questions, which I'm including here, so they're hopefully all on one slide. Reach out if you're interested in talking more, and that's all I have. So thanks for listening.
Thank you so much for the very nice talk and the lovely nerd snipes. So there's one question in the chat, and I see someone raising their hand. So I can read the question from the chat if that helps. For the auctions in a permissionless setting, which are the drawbacks of Dutch auctions? I think this is the only auction which is shield-proof resistant.
That's a great question, and honestly, I would not be qualified to answer.
Okay. And so I saw there was someone. So another question: do we need a definition of censorship resistance in which cost and length of censoring is taken into account?
In which cost and what is taken into account?
The length of censoring. Yes, there is.
Interesting. Yeah, I think that we definitely need I think we have intuition around how to think about censorship in an MEV context, but not really really deep definitions of what exactly we would be optimizing for. What do you measure in say a block building system? How do you know that it's censorship resistant? How do you define that? How do you optimize that property? So yes, I think this is definitely a really interesting thing that we're also kind of working towards a better definition of ourselves. And in terms of those like other factors that you mentioned, yeah, I think that you need to kind of take the economics into account, which I think it was getting at a little bit. It's not just a question of like what are the outcomes for this valid fee paying transaction was not included. You have to also think about, okay, well, like what was the extra simulation that it would have cost the builder to include it? I think these things need to be part of the definition. Otherwise, we're going to end up making definitions that just aren't actually, compatible with the rational thing to do in an MEV setting. And I think that's where things can go wrong. Because if you don't optimize for the economically rational outcome, people will just take side channels outside of your system to optimize for it themselves. So I think that those things are definitely important. And if you are interested in helping us come up with a sort of sound definition, a way to even practically in BuilderNet, but also in general, measure the censorship resistance of MEV systems, I think, would love to collaborate on that.
Okay, well, thank you so much. I see there's another question in the chats. Perhaps you could answer it via text if that's all right. So again, thank you very much for the presentation. And then I'd like to welcome Barnabé for the next presentation.
Hello. Can you hear me fine?
Yes.
Yes, okay, cool. And can you see the slides?
Also, yes.
Also, yes. Okay, all right. Wait, let me expect a bit. Okay. And move this. Yeah. All right. Thank you for having me today. I'm Barnabé Monnot. I work at the Ethereum Foundation research team. Excited to present today protocol roles and MEV opportunities. So give a sense of how we're thinking about MEV when we design the Ethereum protocol, and also wanted to shout out our new website research.ethereum.foundation and mention that we're also hiring. My voice a bit gone. I hope it's fine. So in this talk, I want to basically bring up these themes. It's not going to be fully like a MEV mitigation talk, but I want to give a sense of there are some opportunities that come when you think of MEV as like this energy. So blockchain, I think of it as this marketplace between users who want to transact on chain and service providers or nodes of the chain who can provide these services. And to some extent, some of these service providers exist really because there's MEV, there's economic activity, there's value that's created by the system. And this value allows you to pay people to provide these services. And so, we think a lot of MEV as bad. I think that happens when we think of certain kinds of MEV. But if we think of MEV more largely as like this network value that powers services, I think that also changes the perspective that we may have on it. And these service providers, they come in different shapes. So we see that more and more a differentiation of the kinds of things that blockchains are doing. So Ethereum, for instance, used to be just a smart contract chain. Now it's also doing blobs. So there are different value propositions. There are different things that can be performed by different actors. And being smart in terms of the architecture of all of these things, like routing properly the payments, means that we can harness this diversity. So first, I want to talk a bit about this distinction between what we call local and what we call external builders. So I'll start from the most simple setting that we have today. So Ethereum is a proof of stake system. Anybody can sign up with 32 ETH to become what's called a validator. When you become a validator on chain, you're expected to provide a certain number of services to the chain. So these are some of them that are listed here. You have the FFG service, which is you come to consensus and finalize the chain. So you have this economic security guarantee that the chain can't be reverted. You have to propose blocks. There's different kinds. There's the beacon proposer and the execution proposer role. You have to run the fork choice, LMD Ghost. There's a sync committee that's for light clients. In the future, we may have something that's called Fossil that I'll touch upon at the end of the talk. And then, you have to basically receive the transactions that come from the users and pack them into the blocks and propose them. So this job of packing the transaction is what we call the building job, and the job of proposing the block to the network that contains this transaction, that's the execution proposing. Right, so today we essentially have this picture. So we want to set a minimum validating hardware. That's something that we're actually trying to codify a little bit better. So we say, as long as you have like these kinds of hardware, let's say these little NUCs that are pretty cheap to buy. So as long as you have this software, this hardware, you can validate the chain. So that means you can sign up to become a validator with this 32 ETH and start performing these services. If you were to have less than this hardware, you wouldn't be able to do that. But so the goal here is really to have this fairly cheap access to the hardware so that we have the broadest possible set of nodes that perform these services. And what we do today is we also cap the throughput of the chain. So how much gas, how much transactions, or how much blobs are processed and delivered to essentially what the worst nodes that satisfy these hardware requirements can do. So we make it such that the throughput of the chain can be realized by any of these small nodes, as long as they clear that minimum validating hardware requirement. So that's essentially what I mentioned here. But what we've observed and what's been discussed also in the previous talks is the small nodes of the networks that have signed up to be validators. They're often not performing one of the functions that we assign to them originally, and they delegate that function to nodes that are different nodes of the network, not necessarily validating nodes themselves. So these nodes, we call them the builders or the external builders when it's the case that it's a node that's separate from the validating node. Typically, we can think of these nodes as being just bigger. First, because you have a lot of search space to explore when you want to exploit these MEV opportunities. Like you might want higher bandwidth so that you're really fast. You might have resources that are not just computational, for instance, access to private order flow. Like these are all resources that make you a good builder and an entity that is worth delegating to. What's interesting here is that, in a sense, we are paying these small nodes from the issuance. So the network emits these new FR tokens that incentivize people to join as validators and to perform these tasks honestly. But when you think about it, there's none of this issuance is really going to the pocket of the builders. Like they really get paid from providing that service of being part of a transaction supply chain, and so MEV is definitely the source of their revenue and their existence on the network. So this idea of separating the proposer and the builder, or like the validating node from the external builder, has appeared right after the merge to proof of stake in September 2022. And today we see that most nodes, about 95% of the stake that we have on the network, outsource their building. Typically with MEV Boost, I should have mentioned it in this slide. Now there's a second protocol named Commit Boost that also allows you to make that delegation. So they are both protocols that allow you to call this external network of builders, receive offers from them, and commit to one of the builders to perform the building task on your behalf. So there's positives to that. Like one positive is the network gets these bigger nodes that are incentivized to join and to provide these services. And the second benefit that we get from the protocol perspective is that we're sheltering the validating nodes, and in particular the small nodes, from MEV centralization. So anyone who signs up to be a validator can delegate their building role. Like you don't have to be a sophisticated validator to make good economic returns and to make a lot of money from building these valuable blocks. Like you can delegate that away from you. And so in a sense, this is, I would say, the main tool that we have today for MEV mitigation to prevent this centralization. But of course, it's not free. We like the validator set because it's very decentralized. But if they delegate their building task to a different set of people, the builders, then we inherit some properties from that set, from these agents. And in particular, the builders now become the gateways through which transactions enter on chain. And it means that we also inherit the censorship resistance quality of the building set. And so, yeah, that's not great, but I'll discuss a solution. So now we could represent it this way. So we still have these small nodes at the bottom, this broad set. We still have a target throughput of the chain that's capped to match the performance of these small nodes. But we've actually allowed these bigger nodes to enter the set, and the higher the resources of these bigger nodes are, the fewer these bigger nodes also become. And so an idea that's discussed quite a bit, especially as I think people are really intent on scaling Ethereum and making sure that we can process more transactions, deliver more blobs to the network for rollups, is the idea of decoupling the target throughput of a chain from what the local block builders can accomplish. So remove that constraint of capping throughput to what the small nodes or the smallest node on the network can achieve. Again, it's not free, but there is actually an interesting opportunity here, which is an asymmetry between the cost of building a block and the cost of verifying it or testing it. So you can get a very big node making a big block, but that block can still be easy to verify by the smaller nodes. The main example that we give is the one of blobs. When you build a block that contains many blobs, in the worst case, you have to propagate yourself all of that data that the blobs contain. But the small nodes can convince themselves of the availability of this data by doing much less work than the builders are doing to upload the blobs to the network. And so when you have this asymmetry, then you'd rather give the bigger nodes the building task rather than be capped by what the smallest nodes can achieve. And so we could be in that world. We could be in a world where the target throughput is not limited to this purple line of the minimum validating hardware, but where we allow it to go further and to be in fact matched only by some of the bigger nodes that we have on the network. So the question is, where do we set that arrow? And it's really all about finding balance and understanding like what are the pressures that would prevent us from just setting it to infinity, let's say in the worst case. And so to understand where we should stop or where we should set this target throughput, if we set it away from the local builder limit, we have to understand what are the failure modes that we have from relying on these bigger nodes to deliver that throughput. The first issue is, well, achieving that throughput. So we may say, oh, we want like 1,000 blobs delivered every block on the network. Today we have 3 blobs delivered per block. So yeah, that would be a lot more than we currently have. We could say that we want that, but it's unclear that we would find sufficiently big machines on the network to deliver this. So we don't care only about the target throughput, but we also care about what we effectively achieve when we set that target. It's the first issue. The second issue is the liveness. So when we delegate a task to someone else, like we want them to complete that task. We don't want them to time out or in the worst case to say, yeah, I'll only do the task if you pay me a lot of money. So we don't want them to extort us and take us hostage to the block building process. And then the third risk is again censorship resistance. When we delegate the task to the builders, we inherit their censorship resistance quality. And we make an assumption that censorship resistance quality is just cannot be as strong as the quality of a very large decentralized validator set. So I'll just go through these issues one by one and give some details. Right. So we could be in the situation of telling ourselves, we want the target throughput to be up here, but effectively the chain only processes this much. So in a sense, there's a gap, which means that machines that can fill that gap are going to be, just more prevalent or get higher returns, whereas machines that are lower here are not going to make as much. So there is this question of fairness in a way. The first pressure that comes when we set the target throughput that is too high is that implicitly we're also pressuring the smaller nodes to get bigger themselves. So if the target throughput is really high, for instance, we can have many transactions. That makes the state size increase. It makes it more difficult for small nodes to verify the blocks in time. Perhaps we're at the limit where small nodes are able to validate the blocks and issue attestations, and the small node to want to stay competitive, to want to stay a good consensus participant, will have this incentive to get bigger. So yeah, if we set the target too high, we're obviously going to overshoot that verification limit. So that's the first constraint. But then if we also set the target too high and there's only a couple of machines in the world that are able to match it, we're obviously giving them a lot of advantage compared to smaller machines. And so we also should be mindful of this. So there should be, that's a sweet spot for setting this. So yeah, that's a bit hand wavy, but I think these are the main pressures that we should have in our mind when we think about the right target. So the second issue is about liveness. So we want to ensure that when we want to ensure that we're never in a situation where somebody is taking hostage the block production process of a network. It happens, let's say, in the worst theoretical case, when for some reason we get into a situation where the minimum hardware that's required for building is like way beyond what these maybe small $5,000 servers can achieve, and we force the block to be built by something that's more like a data center sized thing or a supercomputer. So if we ever get into that situation, that would obviously be very bad. Like we would feel pretty uncomfortable that the access to this building market is just not as open as it should be. And so yeah, we should essentially avoid putting ourselves in a case where the network demands such a large block to be built. That could happen in a couple of cases. Let's say if we had forced inclusion of transactions that require like very heavy validity proofs to be computed when we have a zk EVM enshrined on chain. We would never want to be in a scenario where only a couple of provers can progress the chain by delivering their proofs. And so so the solution here, or at least the pressure that keeps us careful, is to prevent these minimum building requirements from ever getting too large. So then the third problem that I think we need to fix to be comfortable delegating this building task is really about the censorship resistance of a network. And so here the solution that we propose is a mechanism called FOSIL, fork choice inclusion list, which selects every slot 16 validators from the validator set, who essentially create packages of transactions that we call inclusion list, and constrain the builder or the block producer of that block to include these transactions. So we have the 16 there, and we get this constrained builder who has to include these transactions unless the block that they make is already full. You can think of it as MEV mitigation, like Shea presented this example of a builder that didn't want to include more transactions because they were already happy with the set that they currently had. So in a fossil world, if we had transactions that were gossiped in the public mempool that one of these 16 nodes included in their inclusion list, the builder would be constrained to include them unless their block is already full. And so so that it's a very powerful mechanism. It multiplies essentially 16 times the censorship resistance quality that we have on chain, and it recovers this ability of the validator set to impose their view of censorship resistance on the builder and not the other way around. And so that's basically the third fix for these three issues. That's all I had to say. I think we should be moving to a world where this target throughput is decoupled from the mean validating hardware. That would give us a bit more room to scale. These are very active discussions in the research and core development communities, and I hope I gave a good overview of the state of the art.
Thank you very much for the presentation. Since we're almost at time, I'd like to thank all audience members and speakers and Fahad for hosting, speaking, and attending, respectively. For those that need to drop out, feel free to do so. And perhaps if there are still some questions, maybe those that can stay a little longer, feel free to ask questions if that's still possible. Perhaps I could, perhaps I could kick it off with one question. Is in the beginning you mentioned that proposer builder separation was aimed at keeping all builders at the same level, but now you also say that builders maybe in the future could be at different levels of hardware sophistication. Could you maybe recap again why that's possible?
I'm sorry, I missed the first part of your question.
At the end of presentation, you say that builders can have different hardware levels, but then at the beginning there was some points with proposed builder separation, we want to have everyone at the same level of hardware. Could you maybe recap why that's possible now?
Right, so we want the validating nodes to have the minimum possible hardware requirements so that we can have the broader set there. We don't necessarily want every builder to have the same requirements, but I think if we overly favor the bigger machines over the small ones, on the one hand, we get better services in a sense, like the network allows itself to have higher throughput because there's bigger machines on the network. But I think we also want to ensure that, access to the market remains open enough that if these very powerful builders decide to play games like extortion or things like this, we can fall back to something that has like weaker maybe throughput, but it is more available than these builders. And in a sense, as long as it's possible to make a block from your validating node, you'll always have this property, even if the block you make from the validating node is much smaller than even the target throughput of a network. It doesn't feel very satisfying. Like you would want validating nodes to make as good blocks as anyone else. But I think it's a pragmatic way of dealing with that trade-off, perhaps.
Okay, perfect. Well, if there are no other questions, yeah, I'd like to thank everyone again. Thank you to the audience, thanks to the speakers, and thank you to Fahad for hosting this symposium. Yeah, with that, I think we have finished today's session.